Hey, it's been a minute. I've been meaning to create this. It's by a request from a friend of mine, and it's talking about introduction or I guess basics to investing. So this video will be helpful for those who are already working, having income, but did not really receive any personal finance education. A lot of these concepts I had to find kind of just doing research on my own. There's so many different articles, so many blog posts, different YouTube videos to learn personal finance as well as books from. So I hope this is a great kind of stepping stone, and I'm more than willing to create more in-depth videos, but I think it'll be this is like a good stepping stone of kind of understanding the importance of investing as well as the different investment vehicles to hopefully create our to pave our path to financial freedom. So with that stated, I've created a presentation earlier before I started recording. So let's start with our presentation, shall we? So let's get started. How to start investing basics. We're going to be doing an overview of the differences between investing and savings, along with different types of investment vehicles. So here's the agenda today. For today, we're going to be discussing what investing is and why you should care. Go over the different investment vehicles, including stocks, bonds, ETF, crypto, mutual funds, CDs, and real estate. And these are just the major ones. There's a lot more, but these are the most common ways that people invest their monies into. So let's first discuss what is investing. Simply, investing is how you put your money to work for a certain period of time on some project in order to generate a positive return. The act of allocating resources with the expectation of generating profit itself, it's called investing. And how this differs from saving is that saving is an act of preserving a portion of your income. So there is no kind of return that is expected. And also another big difference is between the two is risk, which is the chance that an outcome or gains will differ from an expected outcome or return. As the goal of investing is kind of to generate a return, there's always some type of risk that a project may fail. And thus, the more risk that you take upon, the higher the reward to compensate for the risk. And your goal within investing is to make sure you minimize risk through diversification. Measuring risk tolerance. So the goal of the investor again is to measure their risk tolerance, and this is dependent upon your time horizon and how risk averse you are. So let's give an example. If you are 50 years old and you're thinking about retirement, obviously you're going to be more conservative on how you view your finances, right? You can't expect yourself to invest and lose 20% or 10%. You can't really take upon the burden or the responsibility of volatility. Whereas if you're 20 years old, you would be comfortable or more comfortable compared to a 50-year-old of something of a more volatile asset class such as cryptocurrency or stocks, because you know that looking at history and from your research that over time, over a 20-year time period, you're going to be averaging around 10% returns. So that's an example of how every single human being has different time horizons, and this will also impact what type of investment vehicle that you utilize. Another thing to mention within this is the holy grail of investment is to really find investments that offset each other. And this essentially means if one is rising while the other markets is down, then you're hedging properly. And you always want hedges in your portfolio because you don't want everything to collapse, as that will also make you collapse. And you've probably heard this saying where you don't want to put all of your eggs in one basket. So the less correlated your investment vehicle are, the better you are in the long run. But you sometimes hear argument of like, no, it's better to put one egg into one basket if it's performing really well, like it's able to receive 30% or 40% returns. But personally speaking, I believe that diversifying and levying off that risk is much better. And that's based upon like my risk tolerance and also recognizing that there is risk to every option. Another thing to keep in mind is that many people have 3 months of emergency funds in their savings or as reserves for an opportunity to arise. And this is a good kind of rule of thumb to always follow. And this is if you're single, and if you have family, 6 months of savings is a good rule of thumb as well. And making sure you pay off your debts before investing, because if you have any debts, those are also accruing interest. So if you are, investing your money while you have debt to pay off, then you're essentially the interest payments that you're kind of paying, it kind of decreases your ability, your purchasing power. So you always have to make sure you get rid of those debts and lower your costs, because essentially that's allowing you to have more cash flow. I hope that makes sense, and let's move on. So let's discuss the different types of investment vehicles. The definition of investment vehicle is any method by which individuals can invest and ideally grow their money. And the different types we're going to be going over is stocks, bonds, ETF, crypto, mutual funds, CDs, as well as real estate. And CD stands for Certificate of Deposits. So let's first discuss stocks. What are the different properties of stocks? Stock is essentially an equity that represents an ownership of a pie of a corporation. And an example I wrote down is owning a share of Apple. Apple, let's first describe, I wrote the steps down. So first, an Apple would issue stocks to raise some type of capital in an IPO. Let's say IPO stands for initial public offering. And so let's say you are the Apple owner, right? You created Apple, the company, and you need some funding. You need more capital to invest within creating a new product. Then an IPO is a very lucrative way to raise that capital. And this is the incentive behind why companies issue stock. And so the Apple CEO or the owner, whoever founded it, they successfully IPO. That means the stockholder, the person who created Apple, they have shares that they could sell now to the public, which means that they could now raise capital to kind of invest within the company. And this also gives the opportunity for members of the public as well as different investors to buy and sell on the exchange of the Apple stock. And in America, I believe the most common stock exchange is New York Stock Exchange, which kind of dates back, I believe, maybe 1700s or 1800s. And yeah, stocks is usually bought and sold predominantly on stock exchanges and have outperformed most other investments over the long run. And some important statistic to keep in mind is, I believe over a 50-year or 100-year time period, the average returns are 7 to 10%. And let's go to the next one, which is bonds. Bond is a debt security. It's kind of similar to an IOU. And the different types of bond include corporate, municipal, US, as well as treasury. So let's kind of discuss what corporate bonds are. Corporate bonds are debt securities issued by private and public corporations. The municipal bonds are debt securities issued by states, cities, counties, and other government. And last but not least is the US Treasury bonds, which are backed by the credit of the US government, which makes it the safest and most popular investment because they're guaranteed by the US government. Okay, so I have this example down. Let's say Banana City wants to build a new school, and Banana City sells 10-year bond to raise money to build this new school. And you could buy one bond, which means that you have a 10-year bond from Banana City. So this essentially means that you have an IOU, which means that you're going to be earning principal as well as the interest from the city, which is due in 10 years. So how do you make money with bonds? Essentially, you could profit by holding the bond and receiving that interest as well as that guaranteed principal, or you could sell the bond at a higher price because, just that payment that you're receiving could be lucrative for other investors. Next, we have ETFs. ETFs are a basket of securities that trades on the exchange just like the stock. The difference between a stock and ETF is diversification. So stock represents shares within a single individual company, whereas ETFs offer shares of multiple companies. So examples of this would be a VTI, which is the Vanguard Total Index, which comprises of 3,500 US listed companies. And, index fund has been very, very lucrative within the past decades from a lot of people because it seems to outperform a lot of kind of mutual funds that includes like analysts and high fees. So I also listed down different types of ETFs. So we listed the index. We gave an example of an index which tracks particular indexes such as the S&P 500. S&P stands for Standard & Poor, and 500 is the 500 companies by market cap. Commodity is it's kind of like resources such as gold, oil, corn, etc., etc. And essentially, the commodity ETF, it tracks the prices of these. Inverse is designed to profit from the decline of a certain market. Actively managed is designed to outperform index. And then industry tracks specific niches like tech or pharmaceuticals. Next is mutual funds. Now, mutual funds are similar to ETF, except that it differs in number one, management style, and number two, liquidity. And thus, I wrote that mutual funds usually have fund managers, which are actively buying and selling securities within the fund to beat the market and help investors profit. This also means higher fees and higher expense ratios rather than the ETF. And this is why there's a popularity within the index, which we discussed in our prior slide. And mutual funds can be purchased at the end of the day, end of each trading day, whereas ETFs can be bought and sold just like stocks. So there are some limitations within mutual funds. And the steps of how mutual funds work is number one, investor pool money for the mutual fund. Number two, mutual fund invests into stocks, bonds, or securities. And then the mutual fund generates returns, which are passed back to investors. So essentially like what you would do when you're investing in a stock. Cryptocurrency. So essentially what it is it's digital or virtual currency secured by cryptography. And the rise of cryptocurrency within the past couple of years is very fascinating. I think just the aspect of how you're able to trade and exchange money without the government's involvement, giving that decentralized power over the people instead of bureaucracies or institutions is definitely fascinating. And let's kind of go over the advantages as well as the disadvantages. So advantages include a cheaper and faster money transfers. And if I could trace back a little bit, back in 2008, there was the global financial crisis, and blockchain, which was created by the anonymous Satoshi Nakamoto, kind of introduced the idea that, okay, we need an alternative to fiat currency where governments could print infinite supply. It's the first time, I believe, in human technology where we have created something that is fixed in supply. And so that aspect is very fascinating. And the steps of investing into cryptocurrency is very simple. First, you have to choose what crypto to invest in. So making sure that you read different white papers, looking at the developers that are involved, really understanding the use cases. So, and there, unlike stocks, there are no kind of ways, I believe, of evaluating a certain crypto. For example, in stocks, you could do fundamental analysis, but like there's quantitative as well as qualitative analysis that you could do. But within crypto, I'm not sure what the different strategies are. But number two, you have to select what type of crypto exchange you want to purchase. And you should also definitely consider storage as well as your digital wallet. And now let's talk about certain risk. So number one would be cyber attacks. The reason why I mentioned you should consider the storage or digital wallet is because if you don't have your keys, which is kind of like your password to the wallet, then it's not really like your wallet. So making sure that you have your keys, making sure that you are in control of, you could even have a cold storage that could kind of keep you away from cyber attacks. Also, competition of thousands of different blockchain projects, which makes kind of like the space a little there's going to be a lot of speculation. Number three, regulations could definitely change how kind of like the cryptocurrency world operates, as well as volatility. So cryptocurrency, I think, is definitely, you know, how we discussed about risk tolerance. I think younger people are definitely more interested because they have longer time horizons compared to older folks who are more focused on index funds or investing in real estate. Now let's talk about the certificates of deposit, CDs. So these are products offered by banks and credit unions, which provide an interest premium in exchange for a lump sum deposit for a specific time period. And if you do not follow this rule of keeping your money in there, you have to pay a penalty. And they differ from a savings account primarily because this money must be remain untouched for the entirety of the term, or again, you have to pay some type of penalty or you lose interest. So let's say you give an initial deposit of $1,000 for 12 months and it's compounded yearly at an APY of 5%. And APY, it's the formulas down below, you could calculate it as well. So after let's say 1 year, sorry, I missed it should be, this 3 should be a 1. After 1 year, your returns are going to be 1,050. So that means that the interest that you're receiving is $50 because 1,000 times 0.05 is 50. And you know, this depends on how many months as well as how many times it's compounded. But CDs are a much better alternative compared to just having a savings account because of the guarantee as well as, you know, higher rates of return in terms of APY. Last but not least, we have real estate. Real estate is property consisting of land and any permanent structures of improvements on the land. So over many decades, mortgages kind of allowed the middle class to unlock a new asset class called real estate, which was mainly preserved for aristocrats. And currently, this was actually 4 years ago. As of 2019, real estate was the biggest asset class for most Americans, as home ownership marked 64%. And it's considered an appreciating asset and positively correlated with inflation. And other reasons why people invest in real estate is due to a lot of tax advantages as well as predictable cash flow. And you can now make indirect investments in real estate through REITs, which stand for real estate investment trusts. And REITs are mandatory to pay out 90% of their taxable income to shareholders in the form of dividends. So a lot of people who think about retirement utilize REITs as a way of generating to aid their lifestyle. And REITs also have low correlation with stocks, so it's another good reason of diversifying. And I also listed some other, like, how people make money within real estate. Number one, property flipping. So this might be you finding an opportunity to fix the property in itself and to sell it for a higher price. Number two, you could purchase short-term rentals. So maybe it's in a very hot city, hot in terms of demand. So, and then you could sell it for maybe college students, maybe someone who's looking for work. Residential rental properties. This is for example, I want to buy a single family home, and then I could be renting it off to a family, for example. Commercial real estate, maybe there's Apple, going back to that example. Apple wants a building. I have that building, and then I could lease it off to them. Real estate investment trusts, which we talked about prior, they pool their money from their investors and then invest it into different real estate projects. And investors can make money within the real estate appreciation. I believe the average returns are around like 3% per year. But honestly, this depends on like what city, what type of market you're currently in. I believe, the past when interest rates were really, really low and people were just pumping a lot of money, we've seen outsized growth of like 20% returns. But seems to be coming down. As well as cash flow income, we stated that cash flow is really predictable. And then ancillary real estate income, this could involve parking lot, laundry, as well as advertising. So different ways of gaining income from real estate. So that concludes my presentation. And let's go back. All right. So yeah, hope you guys enjoyed that presentation. I had quite a blast creating it, but I feel like I still need to learn a lot more in terms of discussing the intricacies, describing like the data points. But yeah, I hope this was insightful, and thanks for listening, and I'll catch you real soon. All right, take care. Peace.